Go. PPI, June read. Will it be as hot as CPI was yesterday? Actually, very similar. Up 1/10. We're expecting unchanged on headline. Now let's get to the meat. Taking out the meat, food and energy, we have up 0.3, a bit hotter than expected. Ex-food and energy month over month on the trade side, that is unchanged. That's actually a bit cooler. We're expecting up 0.2. Year-over-year numbers. Producer prices, ex-food and energy year-over-year, up 2.3. Remember year-over-year core and CPI yesterday? We have the long string going. This string's even longer. This string has now moved from 22 to 23 months in a row of 2% or higher. And if we look at PPI ex-food and energy trade year-over-year, that's 2.1. So we could talk about a number of issues regarding pricing, and we could talk about the preferred measures of the Fed and the fact that it is one of the variables in the ease that wasn't challenged that most likely will arrive at the end of the month. But truly, if you are monitoring inflation data and looking at a variety of metrics, it's certainly not steaming, but it's definitely not cool. Joe, you're always cool. Back to you.
Yep, I like the hot and cool, which is weird to be able to do both. Rick, stay with us.
Hey, did you read Jim Grant's op-ed regarding
the gold
the
standard
gold and the Snickers and the PhD? Oh my God, that was fabulous, wasn't it?
We love having him on. He's a thinker. He's a thinker.
Absolutely.
My favorite thing he always says that the Fed can make things look better. They just really can't actually make things better. Just make things look better. Anyway, Rick, stay with us. Join us now. Conrad DeQuadros, he's senior economist at RDQ Economics, and our own Steve Liesman. Steve, let's get to you first.
Another one a little hotter than expected. It's kind of funny. It seems like the Fed chairman had it right when he said that decline in inflation was transitory. We don't know yet, right? It's just 1 month of a couple hotter than expected. But there are some other measures out there that people have been looking at. The Cleveland trim mean. There's an Atlanta measure of inflation, which is a little bit hotter than expected. And it was a reason why Raphael Bostic yesterday said, I don't see the case for cutting interest rates. And you just have to ask the question, given what the Fed chairman has said the last couple days, how much the data matters. Is the Fed no longer really data dependent?
You don't want to do it, Conrad.
I think we need to dispense with the notion that the rate cut that it seems we're likely to get at the end of this month has anything to do with the data or the risks, right? We came off an employment report that was extremely strong. We have employment gains that are running 100,000 above the pace of entrance in the labor market. We have inflation that's really close to the Fed's targets, maybe a little bit below.
Can I just underscore one question here, which was not asked of Powell the last couple of days? He kept citing this business uncertainty, and we have had some decline in capital spending. But the most confident thing a business ever does is hire a person. It's a little hard to see the business uncertainty in the hiring.
Well, I'd say even more so make a capital investment. So I'd say that I don't disagree with his view that there's some risk there and businesses might be a little bit uncertain and maybe not have enough certainty to make the investments that we hope they make. However, I think there's a bit of an exaggeration I think the language that he used yesterday was that business confidence has gapped lower. And if you look at the business confidence measures, that's nonsense. Business confidence has come down a little bit, but it's pretty high levels. And as you say, businesses are still hiring. The economy looks fine to us. So this is not really about the data, I don't think. And the inflation data that we've had over the past couple of days show that inflation is pretty close to target too. I don't think it's about the risks, because they think the Fed's exaggerating those risks a bit. I think it's simply about the fact that they don't want to disappoint the market.
Rick, you've never been shy, Rick, about commenting on Federal Reserve policy. What do you think about this imminent rate cut?
I think that they could find plenty of reasons to put forth based on their double pillars, but I really do think it's a waste of a quarter point of insurance. We're throwing a little over 10% of our insurance away, considering we only have 9 of them. Listen, data dependent was one of the things that made me get so enamored so quickly with Jay Powell. And I'm afraid I have to agree with the guest, but he is in a pickle. When the markets get so opinionated, especially the nearby months with Fed fund futures, it really does direct the conversation. It focuses all eyes. Someone once said that there's an issue when central banks become talking points, and we had Art Laffer talking about how they're not democratic, but they are, just like the Supreme Court. Because I'll tell you what, sooner or later, if this type of activity by central banks continue, politicians will be addressing this as platforms, and you'll see voters in action potentially weighing in on the fact that they have now become the Goliaths of the banking universe. And I think in this regard that Jay Powell is succumbing to pressures. I think personally maybe he's a little fearful that the global slowdown, great article on the slowdown in Germany in the Wall Street Journal, I think really that's more what's going on in his brain. It's hard to look at employment, initial jobless claims, even the inflation data. They look at that small little piece, personal consumption expenditure. But at the end of the day, I would be very happy if he takes it back, if we're all looking at a much better economy with slightly firmer pricing pressures ahead. So to me, it's more about the next chapter. I'd like to see Jay Powell much more fluid with respect to rates and actually get back to the central theme of why so many like his pragmatism. Watch the data. Do what investors do. Deal with data, process it, and make the correct decision. Don't load the easing gun before you've seen the targets.